Alright, hello everybody and welcome to today's workshop. My name is Richard and I will be your host for this session. During this session we will focus on leading analysis and the following tools will actually be combined. I'm going to show you a good thing that you guys can actually use as some principles. First is of course what you're all here for, the Elliot wave principle. We will combine it with Fibonacci retracements. The exponential tool is specifically going to be used today, and divergence is the difference in the price action. So these three techniques can actually be an asset to a trader, and they are great to have in your trading arsenal. That's all I can say. So anyway, you are all here to perfect your own strategies. So we will go through it. When it comes to Elliott waves, there are many walkthroughs online, and different types of approaches. That's why it makes it so complicated. That is why traders tend to start using it, and not everyone succeeds in understanding the true concept of it and how it actually works. The Elliott wave principle is subjective amongst the traders and can become very, very controversial. That is also why I will do my best to keep things as simple as possible during this workshop, in order, of course, not to cause any headaches. So that being said, here are some important bullet points to be used as ground rules when using Elliott waves. Now, first thing is basically price action moves in patterns and usually has the magic numbers set to 3 and 5. We'll go through it. I'm gonna show you guys how it all works out. Second is a bullish or bearish Elliott cycle is formed out of 3 impulsive waves, number 1, 3, and 5, and 2 corrective waves, number 2 and 4. These waves, number 2 and 4, they correct the impulsive 1 and 3. And of course, they're followed by the trend correction legs, ABC. We all know ABC, so it's basically quite simple. 1, 2, 3, 4, 5, ABC. No need to complicate things. Very, very simple to use. Well, I'm going to go on the charts later on with you guys. We're going to hunt for a trade. Now, the impulsive impulsive or corrective waves are usually formed from other Elliott waves, as they are fractal by nature. What I mean by that is the fact that you will find Elliott cycles within an Elliott cycle, an Elliott wave within a larger Elliott wave. So basically, let's say an impulsive wave 3 can be formed out of 1, 2, 3, 4, 5. And ABC, of course. So yeah. Now, the impulsive wave number 3 is usually the largest. Sometimes number 5 can be just as strong. We'll actually tell you that. We'll show you guys how to measure that, how to put your, take profit as a target and all that using the expansion tool. Most of the times, but not always, the C corrective wave is also impulsive wave number 1. That is a technique that I'm currently using, and it has a very good effect. Combined, of course, with the risk management. All traders need to manage their accounts. If you don't do it, then you should, because you're not a trader if you don't have risk management on your back. So yeah. Next, ABC correctives can prove a strong gain as well. So at the end of wave 5, depending on the size of the impulsive waves, you will have a strong corrective ABC move. But that, of course, can be established using the ace on the sleeve, which is the divergence at the end of the wave number 5. So now, you guys, some of you are very advanced traders. Some of you, are, let's say, beginning. We all know how it was in the beginning. It can be quite frustrating. So that's why I'm going to keep it simple here. I'm going to walk you through basically the legs, the waves, impulsive correctives, and what you should actually know about them. So let's move a bit towards the wave numbering, right? And the default measurements on them. So wave number 1 is either a simple trend correction or an impulsive wave for another cycle. Just like I said, ABC can be wave number 1 or a simple corrective. Wave number 2 is a corrective or correction, of course, retracement of wave number 1, and it usually does not retrace more than 61.8 of wave 1. Wave number 3 is the next and of course the largest impulsive wave. Usually, not every time, but usually it is. So which can, let's say, offer a 100% or even 161.8 target using the Fibs tools, Fibs expansion tools. So this is why it's specifically used for the measurement of the take profit zone. Wave number 4, it's a corrective of wave 3, and it usually retraces 38.2 or 50% on the Fibs, retraces basically on the wave number 3. 5, last impulsive wave, can be quite big sometimes, even bigger than 3 sometimes, it depends. Elliott waves, they're not perfect, they're imperfect by nature, just like everything in life. Life is imperfect. Life, actually, if you look at it and if you really study Elliott waves, life moves just like Elliott waves. ABC, corrective, then we go up, and so on. So any trader who's a good trader knows that the charts will actually speak to you if you let them. So this is what we're going to do today. I'm going to show you guys a good technique that you can use in your arsenal. So yeah, following up, the ABC after wave number 5, corrective wave corrective wave A. Most you can actually go is towards the beginning of wave number 5. So yeah, wave B, 50% retracement of A, and C usually the same length as A. So that's why we can use the Fibs expansion. Now, before I go on the charts and everything, I know I've been giving you guys a lot of info here. Does anybody have any questions for now? You have the question box. Please feel free. Or any time during this session, you might as well go ahead. All right, so let's go on the charts here. I'm going to focus on a few currency pairs here. Also, we're going to take a look at gold for all you metal traders. Now, on a daily chart, we can clearly see Euro USD is in a channel right here, and this channel is formed of an Elliott wave, right? So let's start counting. After the corrective, which can be treated as an ABC, but I marked it out as an ABC, which is also 1 here, sorry, then 2 corrective, then 3, and then 4 corrective, then 5. At the end of it, at the end of wave number 5, something interesting is actually happening. So we have a divergence. Now I'm using as an indicator. I like to keep my charts clean. Just one indicator with some volumes here, quite rigid by the way, so quite powerful in other words. If you do guys want to use divergences, can be used of course in any type of momentum, let's say oscillators, indicators, but it depends on what type of trader you are, whether you're trading somewhat longer term or short term. Depends if you want your indicator to be soft or more rigid. So here we have a divergence between impulsive wave 3 and 5, and giving us basically trend continuing going on the downside, but volumes picking up, which means the following thing. A new low point was created by wave number 5 impulsive after the corrective 4. So 3 created a new low point, then it retraced, and then a new low point was created lower, of course, than the previous low point, number 3. So normally the volumes should have gone down like this, so that both the trend and both the volumes can be going in the same direction. In other words, this is not happening in this case, which means that, in simple translation, bears they pushed the market lower, but they didn't justify this with the amount of money traded in the market. So it's a divergence. This is a difference in the price action. A weakness from the bear's side because volumes were increasing while the trend was going down. So this is when in December, beginning of December, when President of the ECB Mario Draghi worked his magic. We all remember that day. So corrective wave A has started. Then of course after A it's corrective 50% on the Fibonacci tools, right? Let's mark it out here. Alright, and we have the 50% level right here, 61.8. We're quite satisfied until now. So in order for us to measure wave number 1, this is basically what you want to target. What I would say is what you can trade is best to trade is wave number 1, wave number 3, and wave number 5. This 3 impulsive waves will always give you a good target as a take profit zone. So here's what you can use. On the Fibonacci expansion tool, from the start of wave, we basically measure wave number A and we go to wave number B. So we can put the targets towards 100%. Most of the times it's 100% or a bit more. But I would say that for leg 1, you should keep it at 100%. Keep it realistic. Only at wave number 3 you can basically go in for 150, even 161.8 sometimes. But this is how you measure basically as a target, as a take profit zone. So let's say for example you put your take profit here, and of course you wait for the Elliot wave to work the magic. Also you have the divergence here on this side, so this is basically how you do it. Now following up, right, we can measure wave number 1 and then go to wave number 2, and we can see that wave number 3 is at 100% indeed. Now what's happening right now is wave number 3 has a retracement. I'm on the I'm on daily chart right now, and we're still channeling here. So overall Euro USD is still in an uptrend. It's basically right here what happened is we had the corrective towards wave number 4, right? Corrective wave number 4, and now wave number 5 is forming. I'm not saying that it's going to go up just like that, but it's going to take some time. We're on the daily chart, so if you're a, let's say, conservative trader or long term, let's say, this is basically going to help you out. So as a target for wave number 5, we can use at least 61.8 or between 61.8 or 100%. But there's one more thing that you guys can actually use. Right here, where this price basically, this is the finish of where wave number 3 impulsive finished here and then corrected on the wave number 4, and then of course dropped on 5. Now here wave number 4 created a very significant consolidation area. Consolidation area, what I mean by that is a vibration level where price vibrates, a delicate, significant resistance or support. Now this is basically the point where you will have divergences and all that. So that's basically our target right there. And after that we shall see of course, once it's breached, most likely it's going to gain support. But until there, we need to basically arrive at that point. Wave number 3 impulsive also corrected there on wave number 4, or close to that. Yeah, exactly. Now, if we switch to the lower time frame, let's say, even on wave number 3 you can find divergences. This was a bullish divergence, by the way. There are bearish divergences, of course. There are also, let's say, regular divergences or reverse divergences. Reverse divergences are quite, let's say, quite delicate to understand. It's for advanced, more advanced traders. Let's say, I'm going to give you guys an example right here, just so you know. From the lowest point until this point, right? Let's say between B and 2, we have the trend still going, still showing basically up. But the volumes here are pointing down. So this is a reverse bullish divergence. This is why wave number 3 has been formed right there. Yep. Now going on wave, let's say the finish of wave number 3, what we can actually do, let's say, we can indeed find divergences there. Let's go on the 4-hour chart. Maybe it will be better for you guys. Yep. All right. Now I'm gonna keep the chart clean here so I don't bug you guys. Now, wave number 3 was in fact, of course, the finish of the wave number 5 on a smaller scale. So it's wave number 3 on the daily, but on the hourly, on the 4-hour chart, we will have A, B, C, then obviously C, as I said, it's 1 impulsive, then 2 corrective, 3 impulsive, 4 corrective, and then here it's 5. And as I said, at the end of wave number 5, you wait a bit and you wait for the divergence to put you on a good trade and trade on the correction, right? So this is basically what's happening right now, the correction. Now it's kind of tricky because here we have the wave number 3 actually lower. This is in fact wave number 5, so a new cycle, a new bullish cycle has formed right now. So we can actually say that EURUSD, according to the principle, let's say, right, it might go let's say 1, 2, 3, and then 4 here, and we're expecting a drop. But if we take a close look, this is when last week ECB statement, Mario Draghi again, basically did not have any indication on the deposit rates, and you know, he dodged some questions there, but that's only his style. We all know him, so he rocks the boat most of the times. Now this bullish candle here, of course, this was a sentiment, and right after his speech, right after his statement, then started the corrective, right? So we can treat this on a smaller scale. On the 1 hour chart, let's say, we will definitely have this 1, 2, 3, 4, 5 here, and then the corrective, and then on the sentiment, trying to basically push for another cycle, another bullish cycle, but it was a fake breakout because of the fact that he didn't deliver. So that's when traders took the profit here, basically took profit and basically started selling. So now a new bullish cycle has started. It's forming. So this is wave number 5 on the daily chart. So in other words, we should expect, of course, a quick retracement, but after that, overall on the daily chart, EURUSD is pointing up towards the fifth impulsive wave. So we have on the 4-hour chart the divergence that I told you about. This is a bearish divergence. Trend creating a new high point, also channeling here. because we can see that most of the times when I hit the channel reversed immediately on the waves, of course, but still going up. Channel is still pointing upwards. So my personal expectations is basically wave number 5 to find its way towards the new channel, enter it, and then retrace, and then of course gaining support on that, just like here, gain support on this and shoot towards the peaks of the channel. Because as we can see on the daily chart, these moves are quite strong. A, B, C, 2, 3, and now 4 is barely correcting and then it's starting again. So in other words, EURUSD, in my opinion, I believe that it will form the bullish, basically the impulsive bullish wave number 5. This is for the long run, basically. Now, moving on a little bit, let's switch to GBP USD. Here, basically, after the bearish wave number 5, you guys obviously know the drill. You need to look for divergences, right? So the divergence will basically tell you when the correction is about to start, when the correction will start. So the correction in this case turned into a bullish Elliott wave, right? ABC. I'm gonna shrink the time frame just a little bit so we can zoom into this counts. But overall, we have here wave number 3, 4, and now 5 here, and same situation. Bears pushing the market lower, but volumes are not consistent. Right here, you could say volumes are consistent, right? But right here, no, we definitely have a divergence. So this is basically why the correction has started. Bears running out of steam, bulls coming into play and starting buying. Now let's shrink down a little bit on the 4-hour chart and we can see that bullish Elliott here. So we have, after that, we also have a divergence on the 4-hour chart right here on this small one. Let's see, so right here we have the divergence that we were looking for. Okay, so basically correction has started. A, B, C, which is also impulsive 1, corrective 2, 3 impulsive, 4 corrective, 5. Now here correction has started, but it was not it hasn't basically hadn't started a bearish cycle, right? If we zoom in a little bit, let's see, just placing it right here so you can zoom in on a 1-hour chart, right? We can definitely see among that ABC corrective, we can see a bearish Elliott wave, right? So we can have A, B, C, which is basically 1, then 2, then 3, and 5, and then correctives. Going back. And then after the bearish wave here, the bearish wave corrective, it's both, but it has not started, basically didn't complete the cycle. The counts on the waves on a larger time frame. So again, A, B, C, A, B, C here, 2, 3, 4, 5. Corrective, and then we end up at 5 as well. And now something interesting is happening with the British pound. With the Brexit and everything, British pound is going up a bit, of course. It's going up a lot as well, but something very interesting is happening with the British pound USD as per the market analysis that we posted there in the signal section. Yeah, the Brexit has its rewards for us, but people, basically traders, are, let's say, according to the referendum, it's gonna be quite hard, in my personal opinion. It's gonna be quite hard for UK to leave the Eurozone, because that's, let's face it, right? That's bad for business. If that happens, then people will need visas. Not only that, but corporates will have to move their businesses offshore, right, or in another country. You know, inflation is not going to work out. Jobs will not be added anymore. Simply, the gross domestic product and all that is going to be affected, you know, by the UK. So, because of that, of course, my personal opinion is that you know, just like when it happened with just like what happened with Greece, with Scotland, possibly the same thing to happen for the British pound as well. But very interesting. I'd like to show you the vibration level again here on the British pound US dollar. We can actually see that as well. So same thing as the euro dollar, same thing is happening right here, but GBP USD is a bit ahead of the Euro USD right now. So at this consolidation area, which is basically how I like to call it, the magic box, where the magic happens. This is the crucial retracement zone. But the thing is that this channel has been broken right here. So again, according to the analysis that we posted and with the trades that we mentioned, that crucial level has been broken here, has been breached. So we're looking at the breach of this channel right here, of course, in tandem with the wave number 5 that's gonna take place on the 4-hour chart, right? If we I don't want to take all this off, but here we actually have ABC, right? So it's just a start right now. US dollar, however, let's see, let me go back to the 4-hour chart here. By the way, guys, I'm also taking a look at your question boxes. So let me know if you guys have any questions here. So we mapped this the Elliot waves. Now the thing is that we obviously mentioned trades for both for euro and the British pound, especially for the British pound, which is indeed going right here, according to our trades, going deep in the profit here. And not only that, but it's still showing signs that it's going to continue and gaining support, basically. So our target, let's see, our target for this would be is this Fibonacci expansion here. So we're gonna measure the beginning of wave number 3. Sorry, yeah, all the whole length of wave number 3 and 4, in order for us to have a target for wave number 5, right? So let's say basically our target will be according to how things are going, and the size of this impulsive waves. Wave number 5 also has very good chance of going towards 100% level. So just gonna get rid of this and just leave the line here to show you guys where that is, right? Go to the daily chart. Alrighty. Okay, well, guess what? In the danger zone. So that's basically the next step for the British pound USD on the vibration level here. Here it's basically what happened, a consolidation area, also divergence here at the bottom, so significant, basically a point of interest, if I may say. That's what you're gonna find here. So things are gonna go crazy a little bit in this box right here, in this area. That's why I call it the magic box. Now we're basically let's move on. All right, USD Swiss franc still has a channel here on the daily chart, and if we measure just a little bit, let me go on the 4-hour chart so we can zoom in just a little bit. Okay, all right. Now what happened here is, of course, the bearish Elliot, right? Let me go with you guys here. So this is the fifth wave, and also guess what? You have the divergence here, very nice, and you guys can actually see that if you're patient and you wait for it, you're definitely gonna be in a good situation. But don't forget to use the money management. So that is why also having handed this this calculator here, very important, money management. Now the thing is with risk management, very important not to, let's say, I'm going to focus not more than 2% risk, although some traders use maximum 5, but it's all about on you know, how deep of a, you know, how high your accuracy is. But most of all, if you're a conservative trader, or you know, you just simply don't want to take the higher risk, then you should use 1.5 or maximum 2%. Now the thing is that this is how you place your stop loss, right? So let's say, for example, this using the Elliott wave principle, with combining with divergences or Fibonacci retracement or expansion tool. Even if you're not going to have let's say 8 out of 10 or 7 out of 10 winning trades and this and that, it's not about how many trades you lose. It's really not. What it's all about is how much you gain when you win, because that one trade can put you in a very good position, because you're going to trade on the trend by using the Elliott wave principle, combining it with the divergences as well. Well, let's just see, right? How many pips can you gain? 597, 600 pips in one wave, right? So here, let's say, for example, you took this divergence, right? You know that the corrective will start, A, B, C, right? So you say, all right, I'm going to stop here, all right? Or anyway, you have two choices. Just take the profit, right? It's good profit, 400 pips. It's more than enough, right? But let's say you don't know if it will continue or it's just a retracement from the previous bullish wave, previous bullish cycle, right? So if it's, you just take the profit or you basically continue. But how do you know, right? Well, I also said wave number 2 will not retrace. Let's say, for example, wave number 2, I would give you an advice here, right? Wave, let's take it from the top. Wave, the corrective waves, because that's, you know, when you catch the ABC, right? When you start trading the ABC, the only thing that can go against you would be the correctives, right? Basically the B, the basic counter trends, retracements, right? So B has to be, let's say, not more than 50%. If it is, then by no chance, by no point does it have to go above wave number 1. Sorry, above where A started. I'm sorry, because if that happens, you start counting again. So that can happen to you, to some of you guys. So, you know, just like here, right? Let me show you guys, all right? I say, for example, right here, when you see this bridge, then you know, if you don't have the divergence, then you know it's going to continue. In this case, you have the divergence, right, after the fifth wave right there. So right here, as small as it is, believe me, it makes a difference. All right, moving on. All right, we have the divergence here, A, B, C, 1, 2, 3. But if we switch the lower time frames right here, we can actually see that we will see indeed. I would say that this is wave number 3, then retracement 4, and then 5 continuing here, or this. But if you zoom in, then definitely this is a 4-hour chart. That's why it's so delicate once you don't have strong moves like that. But this is also a consolidation area, but giving you a divergence here as well. So check it out, bullish divergence. Look at this, right? So a new bullish cycle has been formed. Let's say A, B, C on the USD Swiss franc. But something happened right here. You need to be aware of the fundamentals as well, right? Yesterday, Federal Reserve did not give clear indications on the basically they didn't raise the interest rates again. So as expected, as mentioned by us and our teams as well, but they haven't interest rates were not did not rise, so they postponed it, and most of us know exactly how they work and you know what they're doing. But the thing is that this is a trend reversal, right? So we're going to have A, B, C here, all right? C, which is basically A, B, C, 1, 2, 3, 4, and 5. That is why it's going down the corrective once more. So you need to basically combine. If you want a high probability trade, the best advice that I can give you guys is to have the fundamental side and the technical side, you know, both pointing in the same direction, so you have a combo. So yeah, that's basically the best thing to do. If I zoom in on this price action right here on the 1-hour chart, we can actually see here, right? This retracement is to be treated as wave 4 corrective, and then 5, and then of course the divergence on the 1-hour chart as well. Nice, between 3 and 5 going up and volumes going down. Bullish volumes basically decreasing. As I said, divergence, difference in the price action, bulls pushing the market up, creating a new high point. Check the volumes up right here, excellent. Okay, movement is justified. Corrective, a new high point was created. Oh, what do you know? But hey, we don't have the volumes on the side. So you see, that's when the difference in the price action comes into place, and starting basically the corrective, which is to be treated as, you know, on the lower time frame, because as I said, if you're on a higher time frame and you see, let's say, corrective ABC, then you might want to zoom in or you know, expand your senses here on a smaller time frame to find out the correctives, right? So we have A, B, C, 2, 3, 4, and 5 right here in development. So yeah, basically that's what's happening with the USD Swiss franc here. So pay attention to this strong engulfing candles, because you might miss the count, in other words, right? Because we have 1, 2, you can count this as 3 and this as 4, which would be a mistake. This can actually save you, right? You know that the 4 is going to come basically when where wave number 1 impulsive will consolidate a bit. So that's basically what you want to look out for. So this is basically wave number 5 instead of 3. So it saved you right here, right? So if you're going to, let's say, buy right here, USD Swiss franc, you know, it's not gonna work out. Now moving on gold, same as Euro USD, basically. We have the ABC, right? Basically, we entered another channel here. That's basically it. I'm zooming out so that you guys can actually see. the parallel channels right here, where this has gained support, right? One consolidation, two consolidations, and all the way here consolidations at this between these two channels. So this is basically, again, this channel can be treated as a significant support resistance. In this case, a resistance, but we have wave number 5 coming up, right? So the thing is that should gold breach this levels, right, by, let's say, if it enters basically this the next channel, right, it will most likely, in my opinion of course, most likely enter this channel and continue staying there. So it will move, basically change places. So in other words, when it gains support on that after a quick correction, it's only normal, of course, not right away. Yeah, it's set to a new bullish cycle right here in this next channel. Because here we can actually see consolidation. We saw it before right here, and then support all over this this consolidation, and then again consolidation, and price tried to shoot upwards. So it was an ABC, right? But then basically broke the levels. So once this this breach has happened, I also have a doji right here, and I don't know if you guys can actually see this, right? Candlestick formation right here. So boom, entered the next next channel. So basically vice versa. This is what I'm seeing here. Price action going upwards, breaching this consolidation area right here, point of interest, vibration level, call it whatever you want to call it, but it's significant. This is what you need to pay attention to. So once the price breaches this, then of course it's going to most likely it should gain support on that, and price to be pushed, and then again to keep trying. But the thing is that is going to move. So yeah, that's my view on gold here. And also the fifth bullish wave is barely forming right here. So bullish, green volumes here. If you guys are wondering what how to read this the Elliot oscillator, you can find it of course in the right here. Just type it. If you don't have it, it will be installed instantly, no problem. So basically, when the bullish cycles are are forming, or they are already there, you'll have green volumes here, basically telling you, hey, it's a bullish Elliot, or it's neutral, which is white of course, and red is indeed the bearish one. So basically the danger zone. But in this case, green volumes are forming, right? So we're looking basically at this after this fifth wave here, A, B, C. The reason I'm basically keeping a larger view, but if I shrink down on this, we will find Elliots on it, and even here, and even here, and even here, and even here. So each wave can be formed out of other waves. That's the whole principle and the whole fractal thing. So in my opinion, I don't find it so complicated, as long as you don't complicate it yourself with I don't know, minuets, all sorts of measurements and this and that. Well, it depends on what you basically want, right? So what you want to use depends on yourself. Like if you're the type of guy who likes to keep things complicated, or you have your charts full of indicators and none of them point you out on a good thing. That's my personal opinion on lagging indicators as well. That's why I'm focusing on leading analysis, right? And exactly what we're going through today, the Elliots, Fibonacci's, and divergences. These three, I combine it, just like you guys can actually see, but very easily, right? So let's say, for example, we want to measure wave number 5 here. How high can it actually go here? Well, one thing, we need to take a look at the consolidation areas, right? So it's basically between these two channels. So I would say at around 1280, right? As a, let's say, as default. But we can use the Fibonacci expansion to measure this. So when wave 3 has basically started, we measure the whole thing, and wave number 4, right? So we're going to have a target of around 100% for this wave. So that's basically where it's expected to stop, but it has to be higher than 3. So if we take a look at the peaks here, we have exactly what we want, right? We have this peak. Let me mark it off for you guys, right? All right, exactly at that doji, if you guys can actually see it, whereas price most likely reversed, but as a let's say security reason, we're gonna put it basically at the top of this candle, right, where price reversed 2 times from there. This is just a breakout, so a fake one. So that's basically as high as it can go to be valid as a 5th wave, and then retrace, and then same same principle basically to move into the next channel. Now, something interesting happened to Japanese yen today. Of course, you guys saw the charts. By the way, we have some questions. Okay. All right. Yeah. Yeah. Well, I was just on it. I was just on it, John. Yeah. Well, Bank of Japan held off on the stimulus, giving it, of course, some good strength. Now, I'm on GBP JPY right now on the 4-hour chart, and I counted basically after the fifth wave ABC, which is also 1, then 2, 2 corrective, 3 impulsive, 4 corrective, 5 impulsive. And of course, as a live example right here, we could have saw this coming. Of course, that's why I'm emphasizing on this strategy with combining vibration levels with Fibonacci's, but mostly Elliots and divergences. Then you will clearly you will basically, let's say, this session today is all about you expanding your senses as a trader. So if you're not using these techniques, or maybe let's say you should, even if you're not using it and you want to, then after this session we're gonna have the recording available as well, so be sure to ask for it. Now, anything else that you guys would like me to go over, or maybe explain some things again, or okay, all right. Well, so what happened today, right? As I said, Bank of Japan held off on the stimulus. So basically, they want to see how the negative interest rates work out. As a security measure, stimulus has been postponed, right? So giving of course Japanese yen a lot of strength, but as we saw, British pound is gaining strength as well, right? So we're gonna basically, I marked out the corrective here A, B, C, but this might go very, very low, right, according to the measurements of this A. But here's the point. We don't really want to trade right now, right? What we want is to wait for wave number B to be formed. So let's say, for example, we have a bullish candle right here, still for our chart, and we want to measure basically this retracement, right? So we're going to focus basically on 50%. Now, 50% because as I mentioned, corrective, wave number B will most likely be at 50% of wave A. So we have a big wave A right now, right? Can be treated as as an impulsive wave after the full corrective cycle will actually start, because this is basically a correction of this Elliot that I mapped out here. A, B, C, which is also wave number 1 impulsive, then 2, 3, 4, 5, divergence, drop, excellent drop. So we're looking at, either we're looking at a big correction or a big bearish wave right here. However, you have to understand that you need to be aware of the fundamentals, what's happening in the market as well. So that's why we are here as investment mentors, as traders. So to help you guys out. So be my guest and reach out, because you need to invest your time in your education. You need to basically understand how the market works. But none of that, all this analysis, you can be a whiz. None of that works if you don't manage your portfolio. It will be a pity, and seriously, you're just going to be the best trader but the worst one possible in the same time, if I may say, if this makes any sense, because without risk management, you're doomed. You're doomed, because you're gonna win, statistically speaking, even if you have 9 out of 10. If you have 9 out of 10 winnings, at one point you will have 9 out of 10 losings. If you don't have the risk management, if you don't use it, then that one loss or 9 consecutive losses or 5 consecutive losses will wipe out either all your profits gained, all your work, all your blood, sweat and tears, and simply it's not going to work out. That is why you need to do this. You need to understand that risk management is the key. Doesn't matter if you catch every trade in the money. Doesn't matter. What matters is, as I said, it's not basically a matter of how many trades you lose. You don't care about that, because you're going to lose 1.5% on that. Let's say consecutive. You lose one time, next time, 3 times in a row, 4 times in a row, 5 times in a row. Okay, 6th time you win. But when you win, you're using this, let's say, a good analysis. I'm not saying that this is a good analysis. You might as well use it, you might as well not. But it works. So there are some principles here: leading analysis, not lagging indicators. Basically, when you're looking at an oscillator on overbought and oversold conditions, and you say you know that oh it's oversold, I'm gonna buy here, and guess what? If you don't have a divergence there, then why would you sell when everybody? Why would you buy when everybody is selling? You're not paying attention to what's happening. So that's what's going to ruin you. But even with that, right, risk management, I'm going to emphasize this as much as possible, because this is the key actually, right? Because you might have 5 consecutive losses. I'm sorry for my cough. You might have 5 consecutive losses, but that one trade, right? One trade. Let's say, for example, you put a stop loss of put your risk factor at 1.5%, and you lose 750 each trade, right? 750 each trade, 5 times, 3 times, whatever, right? So you lose not more than 75 pips, right? Let's see how much 75 pips is. You lose this much. This much you lose, right? Compared to when you gain, you win 570. Or let's keep it realistic, 300. So even 3 trades lost in a row, you can cover that with this, like one trade. So if you know what's good for you, use risk management. It's actually the key. So even if when you set your take profits and all that, I'd like to focus on the USD Japanese yen according to the news, according to everything that happened basically with Federal Reserve keeping the interest rates on hold and Bank of Japan basically held off on the stimulus. Because fundamentals and technicals are on our side right now. We have this divergence and a new bearish cycle is on the way, right? So what do we need for a confirmation right here? Well, it's pretty obvious. We have a significant support line right here on the USD Japanese yen. If we go on the daily chart, let me zoom in just a little bit. We have a possibility for a continuation here until this levels right here. This was the resistance. Now this bullish Elliot here, bullish momentum wave, breached it, then came back and gained support because this resistance became a new support here and started going sky high. But now Japanese yen is strengthening a lot. We go back to the 4-hour chart right here because the reason why I'm not in a hurry basically right now, and when you trade on divergence and you catch it, well, all right, but the thing is that this can be either a simple correction, a retracement of the previous bullish Elliott wave, or it can turn into a bearish Elliott wave. So I marked out AB here, and we're going to see if we're going to have a wave number C or not. Now, in order for us to measure this, right, most likely right here at this resistance, support, we're going to raise the bar a little bit, let's say around here, right? So we're going to use the Fibonacci expansion tool just for us to measure this, right? So we're going to put it around here, right? Okay. So basically we're shooting for a 100% because usually C has usually the same length as A. That's what we're shooting for. So if indeed this support will be breached, then we're looking at the possibility for a bearish Elliott. So I believe that I have been giving you guys some good indications on the currency pairs, on on trades and everything. But I'm going to give you guys an example as well on this trade. So this is what I'm going to be opening today. Small trade basically here, using the risk management, right? So let's mark it out here. My intention is to open one lot as a size and to take a risk of maximum 1.5, which is going to be 750. Basically, we're gonna calculate the balance here as well. All right. So we're looking at maximum allowed risk of 1,000 from the balance. Maximum 100 pips, right? So let's say, for example, wave number B has finished here, because this is a very strong, very strong move. So I know for a fact that this can't really go the way it looks like, can't really go as high as there. So I can either, you guys can either wait for wave B to be completed and see if the breach will happen or not, or simply use your money management. By the looks of this volumes, everything seems in order. Before I make any preparations, I'm going to shrink down on the time frame here, and at this support we had this divergence right here between 3 and 5, right? And most likely this has chances of going to 2 ways, right? However, I will feel much more comfortable. The reason why I have this moving average period 50 here, EMA, is because I need to measure my measure basically where I'm gonna place the entry, right? So I'm gonna use, let's say, one lot, right? I'm gonna place a limit order for this, not basically just to open a trade for the sake of it. I want to place it at the resistance right here, so that I can actually benefit from something good. So let's say I'm going to mark it out at the bottom of this consolidation and at the top of this one. So as a stop, sorry, this is a buy. Sorry, don't make this mistake, right? So I'm going to place this this limit order for a sell, and obviously use my stop loss. So my stop loss was 100 pips maximum, in order for me to go basically for a 1.5% risk. So after the retracement, of course, wave B shall be in order right here. Then of course I'm going to shoot for wave C, and if we measure it, take profit, I can actually put the take profit, but just in case this will turn into a bearish Elliott wave, I'm going to trade without a take profit and just do this instead. I'm going to trail my stop loss. How I don't know if you guys are using this, and this CTrader platform is awesome from this point of view. Let's say, for example, my trade starts, right, and I start gaining pips. My stop loss has turned into a take basically trailing stop loss. So every time I gain pips, with every pip, my stop loss will move into profit. But when it will, obviously it's not letting me right now because the trade is not active. But let's say if it does retrace, then the trailing stop loss will not move up with the price action. No, it will stay put, and it will basically, worst thing that can happen, you're already in profit. So you're going to get a small profit, but at least it's a profit. So one way of basically protecting yourself in the same time, using money management, but also trailing and measuring your moves, basically. Let's say, for example, this is excellent if you're placing an order and you're leaving the PC or your station, or you simply don't want to take the risk for that. Yeah, I suppose we went through a few things today. Yeah, Peter, you might be right. You know, you don't want to focus just on divergences. You know, Peter is actually saying, looks like just trading divergences will make you good money if you're smart. Well, yeah, but not only if you have a good system and if you use it the right way, um, but also if you, let's say, enhance your senses, right? Because most people are not patient when it comes to divergences. They just see the volumes and that, oh, no, it's basically it. No, it's not really all about that. You need to know when to take that divergence as well. So gave you guys a good tip today. Wave number 5, most of the times, not all the times, and I'm not making a promise here, but most of the times you're going to have the divergence there. So be sure to look it up. That's my trade for today. Um, we had an awesome run in the private investment club. By the way, guys, our doors are always open to help you guys if you do want to get inside the private investment club. Yeah, and that's basically, we went through a lot of good things today. I hope that you found this information useful, or if you do need, if you do have some questions that need to be answered, sorry, be sure to reach out. Our doors are always open for you guys. So yeah, let us know what's up, how we can help you. Before we end this session, is there anything else that you guys would like me to go over, or have any questions, or just shoot? Thank you, Craig. Thank you, Peter. Thanks, guys. Really appreciate the fact that you appreciate all this preparation, and yeah, let us know what you guys need, and we'll be here for you. We're gonna have some good things coming up. Don't want to spoil the party, but we're gonna have some good things, some good surprises for you to help you expand your senses and have good tools of trading as well. Thank you very much. Thank you very much for all your for your time today. Most important thing. Thank you for choosing to invest in your education, in your knowledge, to expand your trading senses. So that's about it. I have a saying that I I have a saying that I like, and it goes like this: stay in the green and many pips ahead. That's what I wish for all of you. Thank you very much as well. Thank you, Kato. All right. Thanks a lot, Rick. Thanks a lot, buddy. All right. Thanks for attending. Be sure to join the next ones. We're gonna have a few. Yeah. Thanks a lot for your time. Have a great day, and as I said, many pips ahead. Bye for now.